Hi, my name is Christina Ngo, and I am from the 11 a.m. class. Today, I will be talking about Case 8, which focuses on 585 Corp, a fictional company that refinanced their loan with their lender. I'll give you more information on this loan and examine the accounting issues that arose from their loan refinancing. So, first, let me give you some background. On January 1st, 2014, 585 Corp borrowed $100 million in an arm's-length transaction. They agreed on an interest rate of 8% with interest payments due annually, so that's about $8 million a year. The principal is due at the maturity date in 2023, along with the last interest payment. On January 1st, 2019, the company decided to refinance their loan to take advantage of the low interest rate environment. The lender agreed to lower the interest rate to 5.5%, with all the other terms of the loan remaining the same. We want to note that the fair market value of the loan at this time was $93 million, which will be important, and I'll talk about more later. Next, I'm going to discuss the accounting issues that arose from the transaction. The company was not sure how to treat this transaction, either as a debt modification or a debt extinguishment. Both will require different accounting treatments. I'll explore both alternatives, and in the end, I'll conclude which is the most appropriate treatment of this loan, as well as the journal entries attached. So in determining if the refinancing was a modification or extinguishment, I created a decision tree to highlight the important questions that guide this determination. And you can find this decision tree on slide 8 of my slide deck. So the first question to consider when making this determination of how to treat this loan is, we want to ask, has the derecognition threshold been met? And I'll get into more of the details into how to determine the answers to each of these questions later. But here, if it has been met, then the company must apply extinguishment accounting, and if it's not been met, then 585 Corp must consider if it's been experiencing any financial difficulties. And if not, then this brings us to our main question, which is the new loan substantially different from the old loan? And if it is substantially different, then we must apply extinguishment accounting to the refinance. And if it's not substantially different, then modification accounting is more appropriate. So to answer the first question in the decision tree, we look to the ASC, which provides guidance on when to derecognize a liability. And this is slide 9. ASC 405-20-10-1 basically says that 585 Corp should derecognize the liability only if it's been extinguished. And the extinguishment criteria here is 1, if the debtor has paid the liability and the lender relieves the debtor from further obligation, or 2, if the debtor has been relieved of the liability through legal means. In this case, 585 Corp has neither repaid the principal to the lender, nor have they been relieved legally. So no, the derecognition threshold has not been met. This leads us to the next point in the decision tree. Is the borrower experiencing financial difficulties? And 585 Corp decided to refinance due to a lower interest rate environment. So there's no indication that the company is experiencing any financial difficulty. Which brings us to our next point. We have to determine if the loan is substantially different from the old loan. This is because ASC 470-50-40-6 says that if the loan is substantially different from the old loan, it must be treated as a debt extinguishment. So this leads us to ask, What is substantial? In ASC 470-50-40-10, it defines substantial through a 10% test. Essentially, if the present value of the cash flows of the new debt is 10% different from the present value of the remaining cash flows of the old debt, then it's considered substantially different. In the same section of the guidance, 40-12, it gives us some guidance on how to calculate the present values of cash flows for the 10% test. It provides a number of instructions from letters like A through G, but since the loan did not have any extra modification costs or floating rates attached, the only guidance that applies here is in letter E of 40-12, which basically says that the discount rate to be used in the comparison of the cash flows should be the effective rate of the old debt, which in this case is 8%. So in slide 13, let me walk you through how I applied the test. To calculate the present value of the original remaining cash flows, I used the effective interest rate to discount the principal and interest to find the present value of the remaining cash flows, which is $100 million. For the new loan, I used the same 8% to discount the new term loans with the new interest payment of $5.5 million. This gave us the present value of the new loans cash flows, which is $90,018,225. So as you can see, when I compare the two numbers, I find that the percent difference between the two is 10.51%. So in our next slide, since the difference is 10.51%, this means that the new loan is substantially different from the old loan, having met the 10% difference threshold. Therefore, 585 Corp must apply extinguishment accounting. ASC 470-50-40-13 provides guidance on how to record the refinance if it is substantially different. So basically it says they must record the debt at fair value, which is $93 million, and they must use the fair value to find the gain or loss in extinguishment, which in this case there is a gain of $7 million, the difference between $100 million and $93 million. And also use the fair value to find the new effective interest rate, which turns out to be 7.217%. So next I'm going to walk you through the journal entries for extinguishment accounting. On January 1st, 2019, the company must write off the old liability by debiting the old liability by $100 million and record the new liability still at $100 million. They also must record the gain, which is $7 million. So that's the journal entry and the date of refinance. To figure out the subsequent journal entries, I created an amortization schedule to help me figure out what the journal's entries would look like for the subsequent years until maturity. Basically, in my schedule, I amortized the loan from the fair value of $93 million until maturity, at which point the company will pay the lender the full $100 million initially borrowed, plus the last interest payment, which is $5.5 million. So in the next slide, those calculations are affected in these journal entries. The company must record debt discount every year to reflect the $7 million gain. And at the end, when they pay off the liability, they'll remove it from the balance sheet by debiting $100 million and then record the last interest expense as well. So that's what the journal entries would look like if the loan were treated as a debt extinguishment. Next, we want to consider a what-if scenario. What would the considerations be if it was a debt modification? So we know that the loan did pass the 10% test, but just for consideration purposes, what if it didn't? ASC 470-50-40-14 says that if the new debt is not substantially different, then we must treat it as a modification. So since it's a modification, we must record any changes to the principal at the refinance date. But since there were no changes to the principal in this case, we don't need to make any adjustments or any journal entries at the date of refinance, January 1st, 2019. So the difference here between extinguishment and modification is that we're not going to consider the fair market value of the loan. So in the next slide, the subsequent journal entries are fairly straightforward. We'll just record interest payments of $5.5 million as an expense every year until the maturity, when we'll record the last interest payment, as well as the full payment of the $100 million initially borrowed. This will materialize as a debit to the debt, effectively removing the debt off of the balance sheet. So in conclusion, I want to summarize our process flow in our last slide. We initially considered the derecognition threshold. We looked at the ASC and concluded that it had not been met. We then considered if the company was experiencing financial difficulties. Since it wasn't, we next had to determine if the loan was substantially different from the old loan. To do this, we applied the 10% test and found that the difference was 10.51%, passing the 10% substantial test, which led us to conclude that the appropriate accounting treatment of the debt refinancing is extinguishment accounting. Thank you for your time and have a great day.